epidemic of something like that, and by the time you know you have an epidemic, you're very well into it. Well, that's what happens in dumb financing.
I am bothered by irrational pay systems, and I'm particularly bothered when average managers take really large sums.
Warren Buffett dissects the complexities of real estate, elaborating on why it often falls short as a lucrative investment option, offering valuable insights for aspiring investors looking to navigate the challenges of this multifaceted market.
Most people like to buy with non-recourse in real estate, and one time I asked Charlie, there was some real estate guy we were talking to, and how do they decide how much a building like this is worth? And the answer is it's whatever they can borrow without signing their name.
Real estate, according to Buffett, is a market fraught with mispricing, setting the stage for an in-depth exploration into the nuances of this asset class and the delicate balance between risk and opportunity.
Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way, and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that.
Charlie once said to me when I was leaving his house a few months ago, I was visiting him. We talked for a couple of hours, and I said to Charlie as I left, I just wasn't anybody else in the house, and I said, except one daughter, and I said, Charlie, I'll just keep doing what we've been doing. And Charlie said, without looking up or pausing a second, he said, that's all you know how to do, Warren.
If you have the house you want to buy, I definitely believe in just going out and probably getting the job done. But in effect, you're probably making something in the area of a 7 or 8% investment implicitly when you do it. So, you'll have to figure out your own equation from that. Charlie probably has better advice on that. He's a big homeowner.
Buffett delves into the intricate world of real estate financing, highlighting the substantial probability of chaos in this particular facet of the business, ultimately revealing the intricacies of managing real estate investments.
Most conditions, it's hard to find real estate that's really mispriced. I mean, when I look at the transactions that REITs engage in currently, and you get a lot of information on that sort of thing, they're very similar, but it's a competitive world, and they all know about what a Class A office building in Chicago or wherever it may be is going to produce. So at least they may all be wrong, as it turns out, because of some unusual events, but it's hard to argue with the current conventional wisdom most of the time in the real estate world. But occasionally there have been some, there could be big opportunities in the field, but if they exist, it will certainly be because there'll be a lot of chaos in real estate financing for one reason or another. We've done some real estate financing, and you have to have the money shut off to quite a degree, probably to get any big mispricing across the board.
The real estate landscape can transform individuals into supplicants, as Buffy shines a light on the often unpredictable and precarious nature of the market, elucidating the mindset needed to thrive within it.
Well, I know what a lot of different businesses are doing, and I just got a report from one of them that happens to be in the retail-related business. And in any event, it was minus 22% in February from a year ago.
In
they
sales?
didn't think that was going to happen.
Sales? You mean
in sales.
Profit? Yeah.
In sales, profits are down a lot more than that. On the other hand, some of our businesses are still doing fine, but they all are reporting that the new, some of them are living off of orders were placed months earlier and that sort of thing. But it's a tougher world, and the railroad business is down, and carloads carried. But it isn't dramatic, and of course we've got a utility business, and that doesn't really vary much with things. But overall, I think people that run our businesses that do have any sensitivity to the economy are surprised at where they are now compared to where they thought they were going to be 6 months ago.
In the course of his narrative, Buffett unveils factors that can disrupt the supply lines of the businesses he manages, painting a vivid picture of potential challenges that can impact both property management and investment strategies.
If you look at real estate generally, you'll understand what the phenomena that's happening if you remind yourself that that's the attitude of most people that have become big in the real estate business, and it does mean then that the lenders are the ones that get the property, and of course they don't want the property usually, so then the real estate operator counts on negotiating with them, and the banks tend to, extend and pretend, and there's all kinds of activities that arrive out of commercial real estate development, which occurs on a big scale, but it all has consequences, and I think we are starting to see the consequences of people who could borrow at 2.5% and find out it doesn't work at current rates, and they hand it back to somebody that gave them all the money they needed to build it.
Money rates within the banking system are at the heart of Buffett's financial perspective, shaping his outlook on real estate and investments, while providing a lens into the global financial system's influence.
Well, I think most of our managers would say that they are surprised at where they are now compared to how they thought they were going to feel 6 months ago at this point.
And
in a lot of businesses, but not in the insurance business, but I think the people at the railroad are somewhat surprised that car loadings aren't a little higher rather than a little lower, somewhat lower. But most of the stuff we carry is essential, but it reflects what's happening. And of course, supply lines were so disrupted and everything a year or two ago that, no economic figures are pure. Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's, if you make mistakes in business, plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but you can't take something that wipes out their capital and expect the world to ignore that fact.
Buffett delves into the financial aspects that trouble him, attributing his concerns to the allocation of resources toward mediocrity and how such financial choices can affect the real estate market.
I would say this, in my own view, the most exorbitant are not necessarily the biggest numbers. What really bothers me is when companies pay a lot of money for mediocrity, and that happens all too often. But we have no quarrel in our subsidiaries, for example, for paying a lot of money for outstanding performance. I mean, we get it back 10 or 20 or 50 for one. And similarly in public companies, we think that there have been managers and are managers who have taken companies to many billions of market value, more than would have happened with virtually anyone else. And they sometimes take a lot of money for that. Sometimes, as in the case of Tom Murphy at Cap Cities, it just didn't make a difference to him. I mean, he performed in a way that would have justified huge sums, but it wasn't. He would tell you that he had all the money he needed, and he just didn't care to take what the market might bear. But I am bothered I am bothered by irrational pay systems, and I'm particularly bothered when average managers take really large sums. I'm bothered when they design or have designed for them systems that are very costly to the company, maybe partly to make themselves look good because they want huge options themselves, so they feel like they give options widely throughout the company. So they design a system that is illogical company-wide because they want one that's illogical for them personally.
The wisdom of running a real estate business unfolds through Buffett's guidance, sharing key strategies and principles for success in this field, offering a comprehensive view of the real estate business's intricacies.
The people who lend too much money should take losses, and they're getting properties handed back to them now. I mean, within the last month or 6 weeks.
The banks are.
Yeah, I mean, they got some office buildings in Los Angeles, and Blackstone walked away from something. I mean, and if you get a non-recourse, everybody goes in the real estate business is told the first rule, the second rule, the third rule is never sign your name to anything. And so you have non-recourse mortgages, and they're going to walk away, and the bank's going to get stuck with losses, and maybe they'll hold the property a long time and it'll come back. And there's all kinds of ways that if you got capital strength, you may decide, well, I'll just hold it, but that money is sterile for quite a while, and that's part of banking. I mean, you expect to lose some money in banking. It's not a sure thing on every loan, and you build that into your calculations, and then you have capital that protects your depositors from it eating into their money. And if it does eat into their money, then the FDIC, which is in effect really a mutual insurance company of a very peculiar sort, essentially spreads the losses among the continuing banks by higher FDIC assessments in the future.
The values that underscore property-based enterprises take center stage as Buffett elucidates the core principles that drive his own business ventures, including ethics, responsibility, and resilience.
From time to time, even in great localities, you've seen it happen in New York a couple of times, in the last 30 years, where the swing in properties values has just been huge. And what we see in our residential brokerage business, and we're in I don't know how many different states, is we see a slowdown every place. Now, we see it most dramatically in some of what have been the hottest markets. And the markets where you're going to, in my view, you're likely to see the greatest fall off and where you've had the biggest bubble are the ones tend to be the high-end market, and they tend to be ones where people have bought for investment or speculation rather than use.
Buffett's narrative stretches through time, offering an evolutionary perspective on the real estate business system and the dynamic changes it has undergone over the years, revealing the adaptation required to navigate the challenges and seize the opportunities in this ever-evolving market.
You don't lose a lot of money, even though the market value on a given day is less than the loan value when families stay together and employment is present and all that. But when you have investment type holdings, or speculation type holdings, when you in effect have had the day traders, of the internet move into the day trading of condos, then you get a market that can move in a big way. First, it sort of stops, and then it kind of reopens.
But large sums per se don't bother me. I'm not saying, whether any individual might want to take them or not, but I do not mind paying a lot of money for performance. It's done in athletics, it's done in entertainment, but in business, the people who are the 200 hitters and the people who would not attract a crowd as an entertainer have worked it out so that, the system has evolved in such a way that many of them take huge sums, and I think that's obscene, but I can tell you there isn't much you can do about it. The system feeds on itself, and companies do look at other companies' proxy statements. Every CEO does, and they say, well, if Joe Smith is worth X, I have to be worth more, and they tell the directors that certainly you wouldn't be hiring anybody that was below average, so how can you pay me below average? And the consultants come in and ratchet up the rewards, and it's not anything that's going to go away. It's like we were talking about campaign finance reform earlier. The people who are the who have their hands on the switch are the beneficiaries of the system, benefiting enormously and perhaps disproportionately from that system.
Dumb lending always has its consequences, and usually on a big scale because you don't see it for quite a while. So therefore, it's like a disease that doesn't manifest itself for a few weeks, and you can have an epidemic of something like that, and by the time you know you have an epidemic, you're very well into it. Well, that's what happens in dumb financing, and you had that. You periodically get it, but you certainly had it in commercial financing in the 80s, and you had the RTC and the savings and loan crisis and all of that, because literally one dumb project was put up after another. A developer will develop anything he can borrow the money against. It's that simple. And when the lending institutions pour the money out for something, it will get built.
We've seen lots of things, and the prices, just don't intrigue us in terms of what we get for our money. I tried to buy a town when I was 21 years old. The U.S. government had a town in Ohio for sale, and would have worked out very well. There's nothing about the arena that turns us off, but we don't see great returns